everyone, and welcome to the Vancouver Resource Investment Conference YouTube channel. We are very honored today as we are joined by Tavi Costa, the portfolio manager at Crescat Capital, who will also be attending the VRIC. Tavi, it's great to have you on the show.
Thanks for having me. Looking forward to this.
I'm looking forward to it as well. And the first thing I want to start off with is a bit of a broad question concerning commodities. Are we entering a commodities super cycle up ahead here? It seems to me that there's a bit of a shift from the overvalued tech sector, and we're starting to see more people wake up and realize that real things, real assets are important. Are you seeing the same thing? And are you do you believe we are either entering or already beginning a commodities bull market at the moment?
I think we're at the early stages of a decade that will favor commodities and tangible assets. And you look at portfolios in general, especially from large capital allocators, and we're not seeing yet this large exposure towards commodities that I think will increase over time. The other thing we're seeing currently, especially in the mining space, is that companies are doing more buybacks and dividends than what they do in capex. In other words, they're giving more money back to shareholders than what they actually invest in their own businesses. And so those are just signs of how extreme companies are really trying to attract capital towards their businesses and stocks. The other thing I would mention that I think it's even more important, well, I remember 3 years ago, I started to look at those capex charts, and you look at the long-term trends for capital spending among natural resource businesses, and that is probably the easiest way to really see what's the cycle, where we are in terms of the cycle for commodities in general. And right now, we're basically at all-time lows when it comes to capex relative to, or I should say, adjusted for GDP, because we've had inflation, $10 million spent in the ground today. It's not $10 million spent back in 2008. So those things need to be adjusted, and the economy is much larger as well. So all that is tying together with one final thought that I think it's probably the most important one. When I came up with this idea of looking at the capex, aggregate capex over time, I think that if I would look back and think about what's going to be the next chart that people will be thinking are incredibly relevant for this, I think will be the manufacturing portion of GDP relative to actual GDP. In other words, how much of a country, especially developed economies, will be accounted for their manufacturing side of their economy. And today in the US is extremely low. I mean, back in the 60s or so, it was about 3 to 4 times what it is today. And I think that we're going to see an increase of that. And in order to see that, it's going to cause a lot of changes. Is part of the deglobalized world. We're going to see less reliance on China, less reliance on Chinese manufacturing, which means they're going to have to reshape most of the infrastructure in developed economies like Europe and the US. They're going to have to reindustrialize some parts of those countries, and that will be require a lot of natural resources, cement, copper, iron ore, all the things that we need to in order to build the infrastructure to allow us to make those shifts. And so for me, that's going to be the huge part. And you remember what happened during the early 2000s with the China entering the WTO. That was precisely what caused China was really building its manufacturing plant. It created a massive demand for those commodities. So it was a long-term trend. So I think it's going to be the same, but now you're talking G7 economies all doing together what we haven't seen in many years.
Well, I want to bring this up. It wasn't something I'd planned to ask you, but you were talking about China. So I want to discuss with you about the current lockdowns happening in China and how you think that might affect the commodities market moving forward. Because a pretty big catalyst, particularly for the oil industry, was that, well, China's going to reopen. We're going to see a whole bunch of new demand brought online. But right now, what we're seeing from the CCP is kind of almost the opposite. We're seeing more lockdowns, potentially more control. So do you think China will eventually fully reopen, or do you think they're going to remain closed? And how do you see that whole picture playing out for commodities?
Well, to start with, I think the general thought from most people is that China has the upper hand with the commodity markets globally. And I don't think that's the case. I think it's the other way around. I think the commodity markets have the upper hand on China. I've been covering China for many years, and it is maybe surprising or maybe all makes sense that China is suffering the most at a time when commodity prices are higher, not lower. And in my view, you want to be thinking about places and countries in the world that are going to be, net importers of commodities over time, and especially in the next decade. That will have severe implications in FX markets, severe implications in equity markets. So I'm long Brazil, for instance, relative to China. Now, to answer your question, lockdowns, it is very, I think, very significant what's happening there. I mean, usually, I think China has a crediting balance, one of the largest we've seen in history. When you look at the checklist for a monetary crisis, I think China has checked all of those boxes, meaning it's got a very low FX reserves relative to money supply. It's got a growth of its crediting balance like we've never seen before. You look at the banking assets relative to GDP are very large. We also look at the delta, the changes in the FX reserves has been in a declining trend. So all those things together point to the direction that there's going to be further pressure on the Chinese currency to the value versus not only the dollar, but really gold. And this is, a strong view that we have. And so those things usually create a lot of political issues, social unrest, and that's certainly what we're seeing right now in China. So the big question now is what is Xi Jinping is going to do at the situation? Is it going to bring back nationalism and other issues with Taiwan, or maybe Tiananmen Square type of event going to play it out? I don't know. I mean, this is a little scary to see that type of power in such a person that is suffering so much pressure right now from its population. So I think it's a big problem, but I don't think this is going to change the direction of the commodities market. In fact, I think that's going to be shifting away from China over time. It's going to be pressuring more companies to make those shifts of relying on China even faster and move back to the US, move back to Europe, move back to Canada, Australia, and so forth, Japan. And so we're still at the beginning of those trends. That's going to be, and we need to think about companies like Apple. How is Apple going to look like in terms of their margins if they can't take advantage of cheap labor like they have been in the last couple of decades? And I think there's a lot of companies in that sort of issue, or that will be facing those questions as well. So valuations are still too high for some of those businesses, and it's all related to China. But I think the commodity markets looks more and more attractive, and there will be parts of the commodity market that will play better than others. But I think it looks quite attractive in my view.
Okay, well, let's dive into that and look at some more specific commodities that you're seeing opportunity in at the moment. Obviously, we've got an energy crisis that is emerging in Europe that could perhaps spread to other parts of the world, which many say is very bullish for the oil and gas sector. Uranium, obviously, a hot topic these days with the whole proliferation of nuclear energy, and more governments and environmentalists kind of embracing that. Gold and silver is obviously something that is front in people's minds in the commodity space. Where are you seeing the most opportunity presenting itself, or is this really something you see across the entire commodities complex in terms of the bullish nature of it?
Well, I do think you want to own a basket of commodities. So I think, and we've been doing this for the last 2 to 3 years. The basket had a larger weight towards energy recently, and we have reduced a little bit that exposure, given the fact that if you look at metals and mining index, PE ratio is at the lowest level since 2008. I think that we're about to see the metals, especially precious metals, lead the way to the upside versus other commodities, which we've been seeing the opposite of that. I think silver relative to the commodities equal weighted index has significantly lagged other natural resources. And I do believe strongly that we're now at that phase. And that is mostly because I have a view about yield curve inversions. And when I calculate yield curve inversions and I see that we're about 76% of the yield curve, the treasury curve inverted, that means that you want to own gold and sell stocks. And sometimes it works just because the gold appreciates a lot more than stocks, or some other times it's just because gold holds its ground, but equity markets collapse. And there are times, especially when you have the commodities to equity ratio at historical lows, where both parts of this lag work very, very well of this trade. And so I do think we're going to see gold leading the way to the upside now. There are questions about a pivoting moment, if the Fed is going to be doing 75 or 50 basis points and so forth. All those questions are going to be reflected in the gold price right now. And I do think we're going to go a lot higher. Financial repression is going to have to come back as a big topic because of the leverage situation we have in the US. And I believe that gold's going to play a big role here.
So how are you viewing the silver market at the moment? Because obviously there's a lot of demand industrially from the creation of solar panels. A lot of this whole push for the new green economy requires a lot of silver. In addition, it has this very long history as a monetary metal. So where are you seeing silver position today? I mean, I was speaking to Doomberg not too long ago, and they were literally saying that without the solar market, that the silver price would collapse. So I'm wondering your take on that and where you see silver up ahead here.
I don't agree with that. I don't think it would collapse. I think it's a monetary metal first and foremost. And if you see gold prices rising and you have 80 or so ratio between gold and silver, I do think that you're going to see allocation towards silver just because of the nature of folks. If they're bullish on the metal itself, they're probably going to look for a bigger risk with higher returns, and that's silver. And platinum will play the same role. So I don't think. I think the higher prices go, the less industrial any commodity will become, and that brings back this monetary aspect of it. I think we've been thinking a lot about silver as industrial aspect just because of how low prices are, especially relative to gold. But if you start seeing silver prices at, let's call it in a more sustainable way, above $50 an ounce or something along those lines, well, it's going to change the discussion towards being a monetary versus an industrial metal. And so those are things that are certainly in my mind. But silver is one of those metals that remains way below its prior highs. We know the demand very well, and we know the supply side extremely well. That is very, very difficult to find high grade silver deposits out there that are currently economic at the prices that we're seeing. So I don't know if silver prices can really fall much further from here because of the supply and demand mismatch that we're seeing. And so I remain very bullish. I thought silver would not be at the prices they are if you asked me 2 years ago. I think that I also didn't think oil was going to have such a big move, especially leading the way. We did own oil. We own a basket of commodities, but you never know which one is going to lead the way. I guess that's my way of thinking. But I do feel strongly that if I look at my portfolio today, I think mining and metals is going to pay my bills. And so I feel very strongly that, especially given the sentiment currently overall, and also how misallocated most portfolios are towards that. And I think we're going to see a big run.
Okay, I'm going to ask you a question that's maybe a little biased for me personally. My portfolio is 100% commodities. Am I crazy here, or should I be looking at other sectors? And should people be looking at other sectors? Obviously, I'm deep in this, right? But I spend every week interviewing people such as yourself who are so knowledgeable on this sector, so I feel very confident in my thesis. But do you think it's important that people should also be diversifying outside of commodities when it comes to their portfolios?
I think there are some plays that you could potentially look at. I mean, I think biotechs there are some opportunities in the biotechnology space. We are not so much investing or deploying capital there, but I can see that there are some opportunities there just because of the valuations, and it's a technology that will continue to be developing over time. I do think that defensive stocks look still expensive, but unfortunately or fortunately, I think we're going to continue to see issues outside geopolitically. But the fortunate side is that we're probably going to see a large percentage of GDP towards military spending, and that will likely drive defensive stocks higher as well. So something to look at. I like Brazilian assets a lot, but that's really involved with my views on commodities. I think Brazilian assets are one of the cheapest parts of markets out there. A lot of people are looking at emerging markets and BRICS sort of as a block. I disagree with that completely, because I think China is a net importer of commodities, while you have Brazil a net exporter. And then you have Russia, which is a net exporter, but it's a geopolitical mass, where Brazil is kind of a Switzerland of South America, where it really is extremely neutral, geopolitically speaking. We'll do business with Russia, China, and also do business with the US, and has, abundance of natural resources, and is extremely cheap right now, especially after Lula came in, which is very similar to early 2000s, when we've had a big run in Brazilian equities, despite the left leadership in the political side. So I think we're going to see something similar in Brazil. And so those are things I would consider that are kind of outside of the, Brazil is related, but outside of the commodities. We like to hedge other things. I mean, I do think there's a business cycle after all, and I do think that the equity markets are still going to go lower. You look at the darlings of the stock market, the ARK investments, software stocks, most of Amazon, Netflix, Facebook are all at the March lows of 2020 already, are below those levels. I do think we're going to see something along those lines ultimately in equity markets. So there's a lot of downside here still. So that's really my hedge. I think, to your point, owning commodities and shorting equity markets is probably the best play you can have in terms of risk reward, as far as risk management as well over time, because I don't know which one's going to go a lot higher and which one goes a lot lower, but I do think the ratio is headed higher, a lot higher, and it's way too low relative to what the fundamentals in the macro environment is probably headed in the next 10 years.
Well, final question here. You will be at the Vancouver Resource Investment Conference January 29th and 30th. That will be at the Vancouver Convention Center. We got a link in the description where you can pick up your tickets for free. But I just wanted to ask you, what will you be presenting? What can we expect from you at next year's VRIC?
I always try to do something very fresh on the macro side. So it's hard for me to come up with a presentation title or anything like that as of today. But I do think I'm probably going to be talking about this commodities to equity ratio idea, because I think it's the idea of the next 10 years. And you must be very focused on those two parts of the market, meaning what are the long opportunities that you have, what are the mixes of commodities should look like, should you own more energy versus mining? I think mining is going to play a big role here just because of where valuations are. So I'm trying to look for exposure there, and also more research there, because that's what drives my conviction into this types of allocations in portfolios. Equity markets, look, I'm probably going to be presenting about that. I'm always looking for what are the biggest risks today. I do think there's risk for Apple, Microsoft. I think there's big risk for credit spreads to blow out, meaning you have corporate bonds still at very high levels in prices that could drop significantly from here. I think there's a lot of consumer discretionary. I don't know if things will play out in the next 1 to 2 months, but I've always had my foundation of ideas and thesis in the macro side, and prices will remain sometimes illogical for some time, irrational for some time, but it's as a portfolio manager, I need to take care of risk, especially, and also look for a lot of opportunities. And I think that in this commodity equity ratio, you kind of get both. And so I'm probably going to be presenting something along the lines of that, and that's really what I've been doing in the last couple of years.
Great. Well, looking very forward to that, and also looking forward to seeing you in January at the VRIC. And thank you so much for joining us today.
Thanks for having me.
We actually need to have a damn good recession.
The Russian economy is a gas station run by the mafia.
$41 trillion has been created out of nothing.
There's a stranglehold in China on most of these resources.
The outlook and fundamentals for the metals remains very, very strong.